Welcome to the Real Estate Explainer podcast, where we talk about anything and everything real estate. I'm your host, Brian Kiczula. Today, I've got Dr. Allen Lomax on the podcast. He's a doctor of psychology. He made his transition into real estate investing in the 1990s. He's currently CEO and investor relations manager of Steed Capital, a multifamily real estate investment firm. And today, I want to focus on raising capital in Regulation D multifamily transactions. The podcast digs a little bit deeper on a number of topics. I hope you enjoy it. Let's jump right into the episode. Allen, thank you for joining me on the podcast today. I just recorded a podcast a few weeks ago on Regulation D offerings with an attorney who specializes in setting up the entities. And I'm excited to have your perspective as an investor relations manager, just because you see it through a different set of eyes.
Well, it's good to be here. I thank you for allowing me to be on your show, and I hope it is an enlightening conversation. So I got started in real estate a long time ago, back in the early 1990s. I had really just gotten into my career, which I was a latecomer to that. I was 42 years old before I finally became an adult and got my feet on the ground. And I was doing what we're told to do, which is you find a financial advisor and you put a little bit away. And I was never satisfied with the returns that would come from that. I'd look at the quarterly statements that came out and would be extraordinarily disappointed. And so I wanted to find another way to really develop my wealth because, I love my job, lots of fulfillment. I've got to find a second income to get out of what I'm doing because I loved being a counselor and a professor. Wanted a little bit more wealth than that profession usually provides. And so I started looking into real estate. And while I was at the University of Guam, I bought a piece of property in Durango, Colorado, where I was from, and had a home built there, a mother-in-law suite, so that I could rent the home out and have a place to come back to when I was here in the States. That was a long time ago. I'd never heard of the word house hacking, but that's essentially what I was doing at that particular time. That worked out very well. It was nice having somebody pay the mortgage. It was nice having a second home for myself that somebody else was paying for. And then, of course, it was appreciating during the time that I was on Guam and I came back to the States and ended up in South Texas. And I essentially continued doing the same thing of purchasing a home and converting it into 2 to 3. And within just a short period of time, less than 10 years, I had really surprisingly accumulated what I thought was a lot of wealth. And for me, it was. And then 2000 and came along and totally wiped me out. And at the same time, cutbacks and everything. I lost the job that had meant a whole lot to me. So that was certainly very, very dark times. And I didn't come through it particularly well. But once I finally started to applying what I always tell my counseling clients to apply, I started finding a way out of it and found that to be, rather than looking at that from a shame and humiliating perspective, which it certainly was, looking at it as an opportunity for growth. So I started looking then at that point in time at, once I let go of all the shame and humiliation of that, I started really evaluating what had gone wrong. And I learned several things from that. I learned that in real estate, you make your money when you purchase, which I wasn't doing. I was purchasing at retail. The second thing is that leverage is great in real estate, but it's easily misused. And I was doing that. And you always need reserves because you never know what the future is going to be, and you need to have those. So with those three things, then I continued studying and looking around, and I realized that it may be, in some respects, easy to get into single family, but it's high risk. It doesn't give you the risk protection that you can find in commercial real estate, and there's several reasons for that. One is that in commercial real estate, you're not relying really upon your own funds. You're not relying upon necessarily your own credit. You're working with teams and with teams that have a lot of experience. The other aspect is that during the 2008 single-family homes nationwide, on an average, they lost about 30 to 35% in value. And it took about 6 years to reclaim that value. Multifamily homes lost about 10% in value and reclaimed that value in about 3 years. So that is risk mitigation there, but the real big risk mitigation is being able to work with experienced teams.
Well, you're seeing the price per unit come down when you're buying multifamily. So instead of buying one single family home, you're buying 10, 20, 30 units in an individual building. So you have more revenue streams or more opportunities within that one project. So that's the risk part, because, a lot of clients do start out in residential real estate, and a lot of people tap out there too. If something goes bad, they'll exit the market and never come back. They're moving to the stock market. They don't want to touch real estate. And I think it's because they're missing what you just said, is that all real estate and all investments have risk. But when you're talking about one asset with one rental income source, so one family living in that property, that does increase the risk quite a bit.
Absolutely, yeah. Thanks for pointing that out. Yes, that's one of the other risk mitigation things, is that if you're purchasing property with 100 units, which is typically what we're investing in, 100 and more units, you're going to have to lose. And we insist on the properties that we invest in that there are enough reserves, there's enough revenues coming in that if they lost 25%, in other words, if they have a 25% vacancy rate, they can still make the bank payments. So that doesn't happen very often in a single family. And you can lose 25 tenants or are not able to pay, and you can still pay your mortgage, whereas, like you just mentioned, with one tenant per unit or per property, that tenant goes out and you're in deep trouble there.
Even with that 25% vacancy factor, factoring that in the beginning, it allows you to go in and do value add. So you can afford to have, let's say, 10% or 10 of those 100 units vacant while you're coming in and doing the improvements so that you can get tenants back into them and increase the property value. So having that ability to cover your debt service on the property while renovating and doing the value adds, I see that as a huge win.
Absolutely. And not necessarily all the properties that we invest in cash flow from day one. It's nice when they do. But like you said, even if they don't, there's still the revenues coming in.
Now, one of the things is raising capital on multifamily units. You're going out and looking for investors to bring into a Reg D offering. So they're coming in as silent partners. It's passive income. So they are really trusting you with the opportunity that you're bringing to them. So if you had to tell them, hey, we might not be generating the income streams in the first month, 6 months, or 12 months that you would typically expect in an investment, but how do you sell that to them? How do you work with your investors? And what's your process? Because you've got a really unique background. And I just think that having the skill set to guide someone through the process is critical.
Well, not all investors have the same needs and desires from the investments they're going into. Some of our investors, they're putting these investments away for 5, 10, or even 15, 20 years later. And so the cash flow is not important to those particular investors. But our investors who are retired and they're relying upon that investment income, well, then they're not going to want to get into an investment that's not cash flowing from the beginning. So we have to know our investors, and we have to know what their particular needs are, and that's how we work with them. I don't sell any of our investment opportunities. I don't have to sell them on it. They're with me because they've gone through our program. They trust me. They know that I'm going to bring to them the opportunities. Everybody in our program, I'm going to present whatever opportunities come available and on the market. But when coaching and counseling them, we're always going to go back to what are their highest aspirations, what do they want their investments to do, and what are their personal values, and are those connecting within this particular investment. And if they're retired and they're relying upon cash flow.
I think that's a great way to approach working with investors and raising capital, is really just taking the check, but really having the conversation with them so they have a clear understanding of what they're getting into and what the time horizons look like. Because like you said, not all investors are investing for the same reasons. And if you have someone who needs to have that steady monthly paycheck, then you're not going to put them in a project that's not going to perform for a couple of years, or maybe it's even longer term. Maybe it's 5+ years. So what a great way to work with investors and really understand their needs.
And those investments are going to vary on that, depending if it's a ground up investment, which is a high risk endeavor. They're probably not going to see any cash flow for 2, it may be even 3 years, like you mentioned there. If it's an existing facility, depending on the extensiveness of the renovations, it may be 3 months before they start. It may be 6 months. We certainly do have properties in this last quarter. We have 2 properties that have cash flowed from day one, and another one that will be cash flowing in another 3 months. So it's not unusual to have cash flowing properties. But that is certainly something that all investors need to be aware of, is when's that cash flow going to start? And there are some projects which we don't even anticipate cash flow. They're ground up developments, and they're going to be selling those properties as soon as they have completed the construction processes there. So there won't be cash flow on that.
How do you curate those individual projects? Are you sticking them in different buckets or opportunities? And then what's the strategy?
Well, that's the beauty of what I do. And that's a good question. And when I decided that I'm going to go the commercial route, I had initially, I'm going to go in and I'm going to be the operator. I'm going to source the properties. I'm going to go through the underwriting processes, the due diligence, the management, and so on and so forth. Well, I got over that pretty quickly, and I realized that would be a ridiculous thing to do because I'm still a professor and I don't want to put the time into that. And then I started looking around, and I had started my podcast. I had an extensive network of experienced and competent, capable syndicators. And the smart thing is to team with somebody who knows what they are doing and has a track record. And so how do I curate those? Well, I have long-term relationships with all of the syndicators that we are working with. I know enough about the due diligence processes and the underwriting processes that I can essentially look at their offering memorandums and have a pretty good idea as to whether this is a viable opportunity or whether it isn't a viable opportunity. But I am trusting the people that I know and work with, and I know them to be ethical. I know them to have extensive track records. And so I put a lot of faith in the fact that they have, in their sourcing processes and in their offering processes, they're putting forth a product that is very viable. But it doesn't always happen that way. I was meeting with an investor just yesterday, and it is a ground-up opportunity, and it's a beautiful complex they're putting together. And there were just a lot of questions in terms of the underwriting.
What is one of the underwriting that you saw? Is it maybe the market rents that they're anticipating collecting? Is it the speed of renting out the units?
It was actually the financing processes. They were relying upon a bridge loan. They hadn't negotiated any interest rate caps. And it was an absolute, in 2 years, you're going to have to refinance this project. And I just wouldn't take any of my investors into a situation like that because we don't know what's going to happen in the next month, much less what's going to happen in 2 years. And we don't know which direction the interest rates are going to go. We don't really know what the economy is going to do in 2 years. And to find yourself in a situation that you absolutely have to refinance in 2 years is a very risky place to be.
Like you said, single-family homes drop by 35%. You're on a 2-year arm with a balloon payment, and you had no option. there was no place to take that loan. So you lose the entire property. And the difference between 2007 and now is you're putting 30% down. This isn't 100% financing. It's not 90% financing. You've got 25 to 30% equity, real money that you've invested into this property in the deal. Looking at everything is so important, and financing is key because most commercial loans, you are going to have to refinance at some point, or they're going to go variable. So you're looking at a straight adjustable, and we don't know what's going to happen.
That was the big thing. And the returns that they were projecting for a ground-up development, they were just not significant enough for me. They were projecting essentially the same returns that we are getting with existing properties with minimal renovation associated with them. So there's no reason to go into a ground-up development unless they are going to be returning anywhere from 28 to 32%, and their returns weren't even close to that. So that was another issue with that. And I was skeptical in terms of them being able to attain the growth rents that they were projecting there. The initial rents probably were in line with where they are, but I think they were over-optimistic.
When you stack 5% every year in perpetuity, you've got an Excel spreadsheet. You can see what it does to your numbers really quick. And I don't know how much most people are earning per month or per year, but it's not going up at 5% in perpetuity.
Exactly, yeah.
So that's important. Now, you're also talking about this ground up development, and I know you do work a lot with value add projects. A couple of things when it comes to value add projects. When you're looking at a property that maybe has been mismanaged, or maybe it's just got deferred maintenance, what type of value adds do you typically do when you're going in and acquiring, let's say, a new apartment complex? What type of value adds are you doing? And what value adds that's a pass on the transaction? I'd like to thank today's sponsor, CostSeg RX, a cost segregation company. If you're interested in a cost segregation study, log on to realestateexplainer.com and click the cost segregation link at the top of the page.
I really let the syndicators make those decisions because it really runs the gamut, and syndicators tend to specialize. And those are the syndicators that I want to work with because they know what they're doing and how to manage it. If it's an extensive renovation and they have experience in extensive renovations, then we've reduced our risk because they've done it before, they have the system in place, and they're going to just put that system in place in that. This one of the properties that we closed on the end of December was a 90s build, 1992, I think. And this operator, they closed, I think, about 10 properties last year, and they have the exact same process because they are vertically aligned. They have in-house construction team, they have in-house property managers, so they're totally and completely vertically integrated, and they're doing complete renovations on every time a vacancy comes up on that. But their process is down pat, and they have everything in-house. Other syndicators, they steer away from those extensive renovation projects because they don't have in-house teams, because they don't have the experience. And yet they have done value adds, and their focus is that they go in and they look for mismanaged properties that, as far as the actual facilities goes, there's not going to be a need for extensive renovation. So I'm looking at the syndicators rather than necessarily the projects there. But a light value add would be going in and replacing countertops and painting the cabinets rather than replacing cabinets, and probably replacing the plumbing and lighting. That's really kind of a light value add. But extensive renovations are going in and really essentially stripping everything out from the flooring to the ceiling.
Perfectly. I think to come back and restate what you said is if you're going to invest with somebody, make sure that they've got a solid track record in the asset class that they're pulling you into. How many deals have they done in multifamily properties? What does their track record look like? if you have a client who's building a car wash, they're managing an apartment complex, and maybe they've got a couple of self-storage facilities, they might have done good with each of those, but they don't have necessarily that track record yet. They don't have 10 under their belt within the last year. So you did answer the question perfectly. So getting back to raising capital and bringing in investors, they've got their money locked up in a money market account, or they've got it in an annuity, or they feel like what they're doing right now is a safe investment. How do you have that conversation with them to make the leap or make the transition of moving their money a lot of times away from their financial advisor who wants them to keep their money where it is, and then bringing it to a real estate type of opportunity? How do you bring in that money when you're raising the capital?
Well, that's a good question. And that's where a lot of people that we work with, where they find themselves. Patrick, for instance, was very successful he's an entrepreneur and had a real estate and insurance company and done very well with that. And that had always been his focus career-wise. He had a financial advisor, like many of us do, and he turned his investments essentially over to them. And I think it was 55-ish or so like that, and he had about $1.5 million, I guess $1.75 is what he had in his portfolio. All of that was in the stock market. And of course, his financial advisors tell him it's diversified across segments, and I'm sure that's true. But to me, he was in a very, very vulnerable position, because when we hit a recession, which we're going to, and who knows when that's going to be. I mean, that's just the way the economy goes. It goes up and it goes down. So it's going to happen at some point in time. And all of Patrick's assets are tied up in stocks and bonds, which are the most vulnerable when we hit a recession like we hit in 2008. So Patrick came into our program. It's a one-on-one mentoring program. We have 6 initial sessions that are educational sessions. And so we had gone through that whole process of why is that real estate the ideal asset? And it is because it offers income, it offers depreciation, it offers equity, appreciation, and leverage. I don't know of any other investment vehicle that has all 5 of those elements. That's what makes it so ideal. And then we look at what are the wealthy doing. And Rise 21 is a peer network organization for high ultra net worth individuals. You have to have 20 million in assets to even get into this peer group. But they do publish what it is that their members are investing in. And they have over 63% of their assets in private placements, and about half of those are in real estate, and less than 17% are in stocks and bonds. So if the wealthy are not putting the bulk of their money into the stock market, then why are the rest of us doing that? And then several years ago, the Federal Reserve Bank of San Francisco did a 150-year longitudinal study, and they compared all investment vehicles against one another, and real estate was the most stable and most secure of all other investment vehicles. So we go through that, and then in our process, we go through, what is a syndication and how are these organizations formed? We go through the full process of private placements and talk about how it is that their money is secured by tangible assets. And we go through the primary documents, the private placement memorandums, the operating agreements, the signature agreements, and look at that from the legal perspective. So before they even invest anything with us, they have a foundation and an understanding of what private placements are and why it is that they're valuable to investors. So by the time we've gone through that, it's not like a big sales job. They have an understanding of the processes. They have an understanding of why it is that private placements are utilized by the wealthy and why it is that they need to be doing the same thing.
Providing the education to the investors, really having the conversations with them, making sure that they understand what they're getting into, if you will, And then moving forward, once you find an investment opportunity that fits their goals or their needs. And you'd mentioned that you've got a program. What is the name of the program and how do the listeners connect with it?
The name of the program is Streams to Impact. The best way to do is just to download our guide, which is exclusive high yield investment blueprint, and they can go to the website and they can get a free copy of that guide. Also, they will find a link there to set up an initial consultation. And that's where we begin the process. And in that consultation, we'll talk about their highest aspirations, what are their values that support those aspirations. We'll look at what are the roadblocks standing in the way of attaining their highest goals, and we'll leave with a blueprint for them. And we'll determine in that consultation if whether or not they're the right fit for our program, and then they, of course, will decide whether we're the fit for them. And this isn't a program for everybody. It's not a program for beginning investors. It's really a program that really is established for those who have $1 million to $1.5 million in investment assets. And generally speaking, the minimum investment is around $50,000. And so you could get in the door with that. But this program really is for people who have $1 million to $1.5 million. So we look at all of those things and decide if they're the right fit for us, and then they need to decide if we're the right fit for them. And no matter the outcome of that, we'll leave that conversation, and they'll leave with a blueprint for developing their wealth.
Before we wrap up, the Steed Talker, your foundation, I believe. What is the background on that? And if you could talk a little bit about that, I'd like to hear about it.
Well, we talked about that very dark time in 2008. Well, it was horses that really helped me through that period of time. And I had always wanted horses, and they came later on in life, like a lot of things did for me. But through that very dark period, there was a very meaningful and deep connection that came about with being around horses and finding that experience of being grounded in the present moment and finding that peace of mind that just comes from being with marvelous, wonderful creatures like horses. And horses are mythological creatures that are powerful. They are fast and speedy. And there is a myth that the Pegasus, the flying horse, struck the ground, I forget on what mountain it was in Greece, and that living fresh waters sprang forth from that. So that's where springs of income or springs of impact come from, is streams of opportunity to create multiple avenues for making meaningful impact in the world.
Really appreciate you sharing that. My wife rides, she's a hunter jumper, and I love going down in the barn and hanging out and just being around him as well. I just want to say thank you very much for joining me on the podcast today.
It's been my pleasure. Thank you so much.